What is up, everyone? Welcome back to another video with the Bear Report. We're going to talk about a company in the fragmented cybersecurity space, and that's Okta. We have found an overwhelming amount of evidence that this company has critical internal issues and is most likely the worst cybersecurity platform on the market. Before we get into the presentation, do us a favor and subscribe to our channel. That way you can stay up to date on our bi-weekly posts. And also, don't forget to like the video if you enjoy this content. So the first thing we're going to cover is management. This is where we'll look at a bunch of issues that fall under management, like resignations, their class action ongoing lawsuit, dilution, and insider selling, and issues with the SEC. Next, we're going to dive into the core business at Okta. Here we will cover their financial statements, multiple hacking incidents, cost-cutting initiatives, increased competition, and the ultimate bear thesis. Like we always do, it's essential to understand the basics of a company so we can better understand the bear thesis. So Okta is supposedly trying to become the leader in IAM services, which stands for Identity and Access Management. Most organizations today use scores of applications. Some are internally developed applications, others are cloud applications. Employees access applications and services from within their corporate network or via their own devices at home. One way in the old way to manage access was to have different passwords for each application. But that quickly runs into issues because many users tend to be lazy and use the same password across multiple applications, which can be a major problem. One leak is all it takes to bring down the entire house. So instead of having the internal IT team manage who has access to what and how, a company like Okta could offload that entire process. Okta's cloud based platform integrates with over 7,000 cloud, mobile, web applications, IT infrastructure, and security vendors. Through them, a company could enforce password policies. Then, through this one interface, employees gain access to all their applications and services. It's supposed to streamline identity and access management, passing on the responsibility of securing everything to a specialist. So, this company is basically trying to modernize enterprises and organizations' infrastructure to this, if you will, digital first operations, which we listed here. The company likes to pound their chest on the innovation they are creating in the IAM space, which is in this case on how enterprises would focus on separate isolated units or silos, as they call them here, rather than being combined into a unified integrated system, which is what Okta is essentially trying to implement. Then here is what Okta really loves to focus on, and that's their C suite executives. So, as listed here, like CEOs, CFOs, COOs, anything with chief level status at a company. They have a heavy target focus here because identity management is important across the board, not just for security or handling critical information data, but for driving business functions and achieving strategic objectives across all levels of leadership. And the C suite level executives are likely to have much more of this critical information and data across a company than your average employee. Now, here you're looking at Okta's two primary areas of focus in the products that are offered under each platform. So, workplace identity and customer identity are two different aspects of identity and access management systems. Workplace identity involves managing the identities of employees and internal users within a specific enterprise or organization. It ensures that the right people have the right access to the company's resources. And these products under this category, as seen here, include single sign on for employees, multi factor authentication, advanced server access for infrastructure, lifecycle management for automating user lifecycle processes, and universal directory for managing all users, groups, and devices. On the other hand, you have customer identity. And this aspect focuses on the management of customer identities, providing a more secure and seamless customer experience across different channels. It's also what they refer to it as customer identity and access management, so CIAM. And the products listed here under this category, you would find products like API access management, uh, to secure access to APIs, user management tools specifically designed for handling customer profiles, uh, preferences, and consent, business to business integration, and much more, as you see here. This here is Okta's land and expand business model. The entire goal is to prospect potential clients, land them for quite some time. Then, upon renewal, you expand services. As time goes on, you then upsell the existing client, and the trend will continue. This has worked well for the company in the years after IPO, but has now kind of plateaued, and they have struggled due to competition with much bigger players now, and the multiple hacking incidents that occurred that doesn't help, which compromised their platform, and we will get into that later as well. So this ultimately gets us to what Okta is trying to become, and that's a one-stop shop for all your identity and access management needs. Innovating this space, trying to build a leading identity platform and moving the industry standard forward. Now that we have gone over what Okta does and have a better understanding of it, what they do, we're going to dive into our first part, which is management. To start off, this is Okta's stock price history from IPO in 2017 up until current today. I want to show a brief visual of the company's stock price correlating to the timeline events that have happened so we understand why the current price levels today are much more than warranted. So in 2017 on the left here, the company IPO'd, gaining significant traction in the cybersecurity space, shareholders getting great gains, reaching highs of nearly $300 per share at one point. Around the time of and slightly before the stock price reached these highs, the company acquired Auth0 for $6 billion, which the market obviously loved here. Unfortunately, after all of this, the company went downhill from here and hasn't come close to recovering. The company suffered from internal problems with many management resignations, the company being hacked multiple times, which is what Okta is supposed to protect its clients from and is their entire business. Then management lied about the issues of these events, with the incidents being much bigger than what management actually initially said. This ended up getting worse for the company, now being involved in a serious ongoing class action lawsuit, which we will get in a little bit later. And the company now trades around $80 to $90 a share. It's very volatile. What we are diving into next, and I want to focus on this like we did in our Palantir presentation, is insider selling and ownership of the two co-founders, Todd McKinnon and Frederick Curris, since the company is still founder-led by them. Then over the next couple slides, we will look in at the insider activity across the entire management team, including the board. But the first thing I want to emphasize is how bizarrely structured the share class was structured between Class A and Class B stock. For a quick summary, Class A are shares available on the public markets, so these are shares you can directly buy in the open market, even for retail investors. Then you have Class B shares, which aren't available on the public markets. They are reserved for management team members through options and awards and have a little more voting power than Class A. This is what the company structured its stock classes between Class A and Class B in a very similar way to what Palantir did. And that was an extremely advantageous and generous way through stock options. I'm telling you this because it's a major building block with the lawsuit into the bear thesis. And we are going to focus on Class A since this tells us whether or not you actually have skin in the game and aren't just giving yourself a payday through Class B shares, which ironically enough is what the founders and management team has been doing. So when the company IPO'd in 2017, the two co-founders received 0 Class A shares. As of the last transaction date, Todd had just over 49,000 shares and Frederick had just over 3,000 shares. These stakes are so small, it's not even worth talking about. They didn't even buy these shares either. In fact, both founders have never bought a single share on the open market. What they have been doing, and I'll show you in real time in the next slides, is converting their extremely generous stock options and awards of Class B shares, letting them vest, then immediately liquidating. So the Class A shares you see left over here is the aftermath of the overwhelming amount of selling transactions that have taken place. I will get into more detail and give more color in our next slide here. Now, here is what is extremely concerning, and I'm not sure why this goes overlooked by both bull and the bear side. This is insider buying and selling between both co-founders Todd and Frederick. And yes, this includes buying, and there has never been a single buy between either of them. But I mean, why would you if you structured the stock class's ecosystem to your advantage by just giving yourself a massive payday of Class B shares through options and awards? Then when they vest, you immediately liquidate. What this has caused and it reflects in the stock price is the incentive to not work hard and diligently for your shareholders, especially when you're operating at a net loss still and diluting shareholders into another dimension. Partly why I say this is because if you look at the top left corner, you can see the total amount of shares sold and the worth between both founders. The amount of shares sold was nearly 3.5 million and total value of just over $325 million. That's just absurd, especially when these all have been converted from Class B into Class A from options that have vested. And the timing when all these transactions were done has really bit them in the butt since they were slapped with that serious class action lawsuit because of it. But after IPO, both founders dumped hundreds of thousands of shares. This continued on the way up to the peak here on this chart. Then, when management lied to shareholders about there being no issues with the Auth0 acquisition, when there actually was and didn't notify publicly to shareholders, they sold tens of millions of dollars of shares right around the peak on insider information, right before the company made its descent into the abyss and never recovered. And at the lows, the company uh, was then slapped with that lawsuit, which is actually intertwined with many other incidents other than the illegal transactions. This is insider buying and selling from the entire management team, including the board. As seen here, this is a much worse illustration than what we just saw with only both co-founders. This is because there was actually never a single buy from the board or entire executive team ever since IPO in 2017 up until current today. And look, our entire goal here at the Bear Report is to be as unbiased as possible. And I know that sometimes it may not seem like that, but that's what our goal is. And when we analyze these businesses, and when you look at this chart and how the stock ecosystem for the company was structured and what has happened with the core business, I don't know how you can't say that all executives here are putting themselves first for the money and shareholders last. And I mean this in the most respectful way possible because it seriously looks like, it looks like a get rich quick scheme, as I noted up here on the peaks. And I also have the insider momentum here for the last 12 months, and it shows almost $630,000 worth of shares sold with only just 5 transactions. And many investors like to go back to the old Peter Lynch quote I always talk about too, but where he says there are many reasons to sell, but only one reason to buy because they think the stock price will go up. This is true. And like always, I have agreed, and it's part of the reason why we don't necessarily take insider activity too seriously. But in this case, and we apply this here, not one person has ever bought, even at all-time lows. So overall, it doesn't reflect well on management because it sends the impression that you truly aren't putting your shareholders first. And that statement makes sense when we look at everything the management team has done and how they've been operating, which we are going to start to get into here next. I want to show this now so we can have the additional color on what this class action lawsuit is really about. The basis of the allegations in the lawsuit primarily revolves around insider trading and breaches of fiduciary duties by the defendants, which the defendants here is which is the entire management team, including those that have resigned. They are accused of selling Okta shares while in possession of material of what they call non-public information, which I was talking about previously. There is an overwhelming amount of proof that management knew the truth about various issues within the company, including problems with efforts to integrate the Auth0 acquisition, inadequate cyber controls, and the susceptibility of Okta to data breaches, including the severity of data breaches caused by the multiple hacking groups. They are accused of trading based on this information, which led to significant proceeds from the sales of inflated Okta stock at peaks, which is why I showed those illustrations first, because the timing makes complete sense when you look at them. The allegations suggest, word for word here, that management breached their fiduciary duties by allowing the company to spread false and misleading statements, failing to maintain an adequate system of oversight, disclosure controls, and procedures, in making or causing the company to make false and or misleading statements and omissions of material facts. The allegations say these actions ultimately resulted in damages to Okta, including financial losses, legal fees, and reputational harm. And it also asserts that these actions demonstrate a failure to act in the best interests of the company and its shareholders, constituting violations of fiduciary duties. So, like I said, putting management first and shareholders last. This is ongoing too, and it's actually a jury trial. So, if found guilty, which is likely the case, or settling for a significant premium, we could see a major decline in capital. In capital depreciation in the stock price at current levels today. Now we are going to get into what really has been holding this company back, and that's the excessive stock based compensation, which in return has created rapid dilution over the years for shareholders. As seen at the top here, stock based compensation IPO for the half the year in 2017 was just over $17 million. That doesn't seem like much at the time because it really isn't, but that's partly due because the company IPOing toward the middle of the year in 2017. As of the fiscal year end of 2023, the company had a whopping $677 million in stock based compensation. This is horrible since it's above the general rule of thumb and the company is operating at a significant loss. I will show specifically in our next slide year over year as well, but from IPO up until current, the average year over year percentage of stock based compensation is 124%. These are big numbers we're talking about, and they do have a material impact on the business, especially when the company is managed poorly. And next down here, we have dilution, which is the byproduct of stock based compensation. So the company IPO'd with just over 12 million shares, which is an excellent low float starting out, actually. And then as of last quarter, the company had just over 164 million shares outstanding. This represents a 1,200% increase in the outstanding float since IPO, which is really kind of hard to believe. Now, most investors will try to justify this by saying that is what SaaS companies do. Yeah, that's true. Many SaaS companies have a higher average of stock based compensation at 10%, give or take. However, this only applies to companies that are in growth mode for a couple years and are either profitable or about to reach profitability. Okta is neither of these and has been handing out stock based compensation like a drunken sailor for more than just a couple years now. So I don't know how investors can really justify this. What you are looking at here is the stock based compensation for each year, starting with 2017, then ending on Q3 2024 fiscal year. If we navigate to the top here, you can see I added 2017 because that had to be manually inputted and added. But if you go ahead and look at 2018's year, you can start to see the major jumps in total stock based compensation. 2018 listed at around 49 million, then 2019 ending around 76 million, and 2020 with the biggest jump around 126 million. As we make our way to the middle of this chart, you will see 2021 through 2023 fiscal years ended. Now we start to see the inflection point on where stock-based compensation starts to get out of control. In 2021, stock-based compensation was nearly $200 million. 2022 increased 5 times 2021's total compensation amount, reaching $566 million. And in 2023, increasing again to that 677 million number. As we were going over this, eh, you can just make the observation here and see where the company just continues to pile on more and more year over year. When we take a look at their most recent quarter, which is current, compensation for the fiscal year 2024 is actually going to be higher than the previous year, surpassing it. As for a general rule of thumb, which was discussed thoroughly for SaaS companies in the Palantir presentation, once you start getting above 10 to 12% consistently, that's when it is technically considered too high. And again, when we analyze these year over year increases, the average compensation increase is 124% year over year. Any reasonable investor, even if the company is making a profit, will tell you this is unsustainable in the long term because you are rapidly increasing dilution on a large scale. I would likely cut this company some slack if they are profitable, but the fact that you are still operating at a net loss, it just isn't good. And we will see why later in this presentation. Now we're going to see the after effects of what excessive stock based compensation does to a company, and that's diluting shareholders. So, what we have here are the year over year annual increases in the outstanding share count. all underlined in red. Again, I had to input 2017's float manually, and just over 12 million shares was what the company IPO'd with after their offering. When we continue along on the timeline, we start to see the effects of the compensation take hold here. In 2018, the share count jumped to 24 million. Then in 2019, the share count went up to 92 million. So this was a big jump. Then in 2020, the share count rose to 107 million. So within 4 years, well, technically 3.5, the share count basically 10 times. As we go to the middle here for 2021, the share count rose to 118. And in 2022, rose again to 140 million shares. Into the end of 2023, the company had approximately 150 million shares outstanding. So within just 3 years, the company added an additional 50 million shares to their float. And keep in mind, this company is still operating deep in the red. As we take our attention to the bottom here, their most recent quarterly filing for Q3 2024 fiscal year, they reported another increase of 164 million. And stock-based compensation is actually going to be higher than any other year this year. So we can expect that this 2024 fiscal year ended will end in an even higher share count than what we see right now. This is what poor management decisions from compensation will do to a company and shareholders. It dilutes them and they lose value. You can even see the increases in the outstanding share count on the left side here. I calculated year over year increase for each year. Again, much higher than the industry standard. The industry average. So since the company IPO'd, shareholders have been diluted over 1,000% in just 6.5 years. Now that we have finished covering the nitty gritty of compensation and dilution, I want to talk about something concerning I found while digging through all the SEC filings. And that's the SEC letters Okta has received from the Securities and Exchange Commission about accounting practices and lack of transparency. I have gone over how the SEC hovers over companies to enforce transparency and stuff in our Nanox presentation. But oftentimes, when the SEC starts snooping around and sending letters to your company, it's never a good thing, especially when it happens more than once. Picture these like a slap on the wrist. And if you fail to comply after multiple times, they can make the process much more difficult for you, which is what we saw in our analysis with Nanox. And as I put on the screen here, they received 5 letters. You can go back and find these listed on the SEC. They were kind of hidden in there, but they are there. Most of them were for your basic reporting requirements as a public company they got wrong. Also clarifying the correct accounting practices and details about their clientele. In a simple way to put it, the SEC felt like there was a lack of transparency. And with all of what we have covered so far, it really starts to make sense about this management team. Another concerning aspect of this company is the management turnover in such a short time period. Ironically enough, it was being done in the time periods where potential fraud was being committed with the Auth0 acquisition, insider selling, and not disclosing information publicly to shareholders. What you are looking at here is a timeline of management resignations, which I'll give color on each. The first resignation came from the CFO, Mike Corney, in 2021, right when the company was experiencing more losses than expected and during the Auth0 acquisition. There wasn't any detailed explanation on why this happened suddenly. Then, in the beginning of 2022, the chief marketing officer, Kendall Collins, stepped down without any explanation. Immediately after this, we start to get a chain reaction of resignations. The next being the new channel chief, Steve Dodenhoff. Again, there was no detailed explanation. Then, during the time of the Auth0 crisis, co-founder and CEO Frederick Karis decides to take a sabbatical, and when he got back, he never returned to his role as CEO. Of the bunch, this is the most bizarre, since the company was struggling internally, and he just decided to get up and leave. Go figure. I don't know. Now, not as serious, since I genuinely believe this was retirement, but Susan Ledger retired from her position as president of worldwide operations. I do think it's still not a good look departing the company after all these resignations happen, though. But as we get into the beginning of 2023, we have a resignation from the chief revenue officer, Steve Rowland. which stemmed from a lack of performance and disagreements among management. Continuing after this resignation, we have the general counsel, Jonathan Runyon, leaving the company during a class action lawsuit is ongoing. This really should just tell you everything you need to know. Uh, what's going on within the company, the lawsuit against this company, even with all these resignations taking place, it does not reflect well. Lastly, one of the independent board of directors decided to step away from his role, and that was Patrick Grady. I mean, look, with all of this taking place in such a short amount of time and being done amid questionable time periods, like we mentioned above, this should concern shareholders. And lastly, we are going to dive into the core business and go over the financial statements, the multiple hacking incidents, cost cutting initiatives, increased competition, and our ultimate bear thesis. Like always, we are going to take a look at their financial statements and analyze the metrics that deserve our attention. What you are looking at here is their most recent 10Q. We're going to analyze both 3 months ended and 9 months ended for the metrics represented in the visual. If we take our attention to the top here, to subscription revenue, it was actually up both 22% for 3 months and up 24% for 9 months, year over year. Right below this, professional services and other ancillary services, which is they define as training, support, and consulting, were flat at 0% for 3 months and down 10% for 9 months, year over year. When we look at the total revenue below that, both were up for the year at 21% for 3 months and 23% for 9 months ended. As we drift down to gross profit, this was also up for both years ended, with 3 months at 28% and 9 months at 23%. And as we drift a little bit further down to total operating expenses, this was flat for 3 months, but up 3 months for 9 months ended. So overall, these numbers look good at first glance. We can all agree on that. But I will show you why it's really not when we dig deeper here at the bottom. When we look at net loss, it is actually improving, which is why I have it in green. But if you look at both 3 months and 9 months, these losses are in the hundreds of millions of dollars still. So, yes, the company isn't generating a profit yet. And they've been on the public for almost 7 years now trying to achieve this milestone. Most of this is because of the incidents in the past, management's poor decisions with their compensation, seen at the bottom here, circled, and the major competition in the space, the cybersecurity space, which is causing such slow platform growth. The improvements you see here, though, was from lots of cost cutting and restructuring, which I'll get into later. And they are still unable to generate that profit, even though those metrics are improving. To be frank, it's going to continue to be even more difficult with mega cap companies entering this arena now, or even just better platforms that have their integrity and are secure. Next, we're going to look at their cash flow statement for their most recent 10Q. This will give you a better idea on their losses in decision making. Right up here at the top, where we see net loss for 9 months ended, which we went over last slide. I just want to reinforce they're significantly operating in the red, and I assume they will end the year up in the mid 400s. As seen right below it, we can see the amount of stock-based compensation they are handing out, which I still can't understand why this isn't being addressed since it's accounted as an expense. And as we shift to the middle of the visual to net cash provided by operating activities, the company actually generated some cash. So the company is actually cash flow positive, yet they are still not generating a profit. Usually, when you have a scenario like this and the company is still unable to achieve profitability from operations, it is a sign of bad management. It's in every single history book in company that has gone through this. It's a sign of bad management. And what they do is they try to restructure, they cost cut, they bounce around to many different ideas and business models. But that is what it is, especially when this milestone has been trying to be met for nearly 7 years now. When we go down here to net cash provided by used in investing activities, which is proceeds from investments they sold, it was up over 1,000%. I put this in red because the company is liquidating certain investments to pay down debt right now. Then below this, at net cash provided by used in financing activities, the company actually paid $774 million to pay down debt. So what they did is they actually took the $574 million they liquidated from investments in part of the $338 million from operation to pay this right now. This left them with only $137 million after it was all said and done below. So it did increase their cash position, but I don't believe this is the best use of capital at the moment. Some will argue and say it is, since they are paying off debt, even though a third of it wasn't even due. I mean, we strongly disagree when the boogeyman and elephant in the room is still not being addressed, and that's the compensation. With the company still operating at a significant net loss and issues of the underlying business still aren't being addressed, and when tweaked, could be a major inflection point for them toward profitability, it's hard for any investor to sit here and say, this is the best use of capital. Although, I mean, it could be debated. And this is where we are going to get into one of the major building blocks to our bear thesis. And this is about the multiple hacking incidents that the company faced and how management wasn't going to tell shareholders or customers about the first incident, then lied to shareholders and customers about the damage that was done. So, as seen here, Okta's cybersecurity platform was breached and compromised by a hacker group called Lapsus in 2022. The very thing Okta exists for, and they were still breached. Management didn't say anything about the hacker group when it was actively ongoing. They weren't going to disclose it until Lapsus posted the amount of data it hacked from each customer on Telegram. After this was all said and done, management came out and let shareholders and its clientele know that it only lasted 25 minutes and hacked only 2 customers. However, this was actually a lie, which I will show you next. Not to mention the company was they were just not going to say anything about the incident if Lapsus didn't leak its damage across the social platforms. So about a year later, Okta came out and said data was stolen from all customers it services. This right here, the whole debacle, should tell you everything about this management team. After this, I just don't know how investors who are bullish on this company can trust the executive team. This was a big no-no. Then after the Lapsus hacking group incident, the company was breached yet again by anonymous hacking group. So now, not only can we trust management, but how can you trust Okta's platform to securely protect your data? This points us to another question. Well, why would you choose Okta to service your needs when there are better and more secure options in this space? Okta's stock price took a major tumble upon this news, including the lawsuit almost hitting near IPO levels again, and since hasn't recovered. As the stock tumbled after all the that has plagued the company, management has had to make a series of layoffs within the company to cut costs. The first round of layoffs started in the beginning of 2023, which was around 300 employees. Then, most recently, exactly a year from last layoffs, the company announced yet another round. This time it was around 400 employees. Right now, Okta management is trying to do everything they can to accelerate the path to profitable operations or just get their net losses from widening further here on out. All right, now what we're going to look at before we look at the overall bear thesis on this company is the extreme competition in this space. On the upper right here, we have Okta's current market cap value. On the left, we have companies that are direct competitors to Okta or are currently expanding into their primary area of focus. I'm going to start with the smallest companies first, then work our way up to our largest competitors. First, over here in the left is CyberArk, which is valued around Okta's valuation. Then we have one of the biggest competitors, or threats, if you will, to Okta, and that's Thoma Bravo. Although not public, they have acquired many, many businesses that have accelerated their position in cybersecurity. It is said that they have a portfolio worth over $50 billion, which is considered, pretty conservative. Next, we have our famous CrowdStrike, which is actively expanding their services into IMM services in hopes of becoming that one-stop shop for all cyber needs, and they are valued at $75 billion. Then we have Palo Alto Networks, which everyone I'm sure has heard of, valued above 115 billion. So these are pretty big companies. Okay, you're getting into almost mega cap territory. Next are the big guys in this is IBM. It's valued over 170 billion. Then you have Oracle, who's over 305 billion, and yes, the largest company in the world, Microsoft, around 3 trillion. My question to Bulls is, do you really think Okta has the wherewithal to handle this highly fragmented and competitive space in their position right now? And can you really trust Okta to handle your cybersecurity needs? Okta is the only company of this bunch that has been severely breached with their services it provides. So this hinders their ability to scale greatly since they don't have that competitive advantage they used to tout about for their identity and access management services anymore. Every company listed here is generating a profit too, with the exception of CyberArk. And this should greatly concern shareholders and potential investors. Lastly, this gets us to our bear thesis on this company, and we believe the company has a very weak security platform and critical internal issues. As someone who is a reasonable investor, with the information listed within this presentation, it's pretty clear this company has been poorly run and is a low tier option for your cybersecurity needs. That should be pretty obvious. With the repeated lack of transparency and hacking incidents that have taken place, absurd insider selling and management turnover, which hints at potential fraud, unsustainable stock based compensation, and continued net losses, and the ongoing lawsuit that will likely find them guilty, and if not, have them settle for that premium, really highlights these primary concerns that Okta is that not only do they have a fragile security platform, but faces some very critical internal issues. But that is it for this presentation. If you enjoy this content, make sure you subscribe to our channel so you can stay up to date on all of our future posts. And don't forget to like the video. Thanks for watching.